The space of the fortnight, and that's banking as a sector. We thought we'll talk to Kotak Bank, get a sense of their retail lending, which is becoming a tougher space to be in, get an outlook on the consumer finance as well as retail banking business. Banks have now hiked deposit as well as lending rates. So what's the outlook going out there from here? Who better than Shanti Ekambaram, the President Consumer Banking at Kotak Mahindra Bank, joins us on the show right now. Shanti, morning. Pleasure speaking with you. We've been planning this interaction for a while, but glad it's come about today. Tell us about the competition in the retail lending as well as consumer banking spaces right now, Shanti, because it's getting an extremely competitive space out there. Are pressures on spreads as well as yields something that you can't fight right now?
So first, let me talk about the trends. Sure. I think if you look at the last 6 to 9 months, consumption has actually, both in the urban and the rural markets or semi-urban markets, have actually gone up. People are actually consuming more, and if you look at the products that from a lending perspective, whether it's credit cards, particularly post demonetization, personal loans, mortgages, small businesses, in fact the working capital demand from small businesses and a number of new to credit borrowers as well post GST have come into the market. So from a demand perspective, last 6 to 9 months actually have seen some very interesting trend. It used to be stable, but we are seeing a clear uptick in demand. Now, when there is an uptick in demand and there is a lot of supply as well, you've got to be really focused on which is the segment that you're focusing on. Yes, I think the retail segment market has been extremely competitive. Some parts of the segment like the credit cards, personal loan, despite being competitive, you are able to get your pricing. Home loans is a segment that's been extremely competitive and fine pricing, but even there, and you saw today's announcements as well, whereby HDFC Limited has upped its rate as up to as much as 20 basis points. There's been some stability that has come into the rates and possibly some amount of increase. So I'd say demand has been good, supply continues to be strong, but I think the market, India being a diverse market from a geography, market, segment perspective, there is still a lot of unmet demand and thus growth opportunities as far as players are concerned. And you have players who are diversified, which is who will play in all the consumer lending segments, and you'll have players who are very focused maybe in one segment, and thus there are different strategies that play out. Yes, it is competitive, yes, margins are under pressure, but I think you've got to look at how you play this business, how do you price risk. At the end of the day, retail lending business is about pricing and pricing risk. If you price risk appropriately in different segments, you're okay.
Okay, so you highlighted that, when it comes to consumption, demand, it's looking strong. But what about retail assets for you in particular when it comes to mortgages? What about your LAP book?
So if you look at the growth in mortgages and LAP, and you've seen our December numbers, it is in the range of anywhere around 18 to 20%, and mortgages continues to grow. See, at the end of the day, for a bank like us, it is largely about lending to your existing customers. A large part of your retail lending, about 60% or so, comes from your existing customers. And you know that we have been growing our customer base pretty exponentially, particularly if you look at the last 1 year. The rest of it really, we look at the open market and markets where we are. So from our perspective, we have been growing at a pretty healthy clip on both mortgages, loan against property, credit cards, personal loans. So across the lending segment, particularly the small working capital business loan, we've seen demand from our customers really go up if you look at the last 12 months in perspective. So both customer acquisition has been at a very healthy clip, and cross-sell into our customer base, which is what our core business model is about, continues to see strong demand.
Shanti, so the demand side is intact, and that's heartening to hear. But with what HDFC has done yesterday, which is in a long time, raised rates for the very first time, indicating to the market that brace yourself, the pricing of loans is likely to get more expensive. How do you think that would impact the market in the near term? I'm not saying it's going to happen overnight. I'm not even saying it's going to happen in 3 months, 6 months. But the way forward is that we would be in a tightening scenario soon enough.
So if you look at the last 3 years in perspective, a home loan rate has come off more than 100 basis points. What has happened in the last 3 months? Banks raised rates by about maximum 10 basis points, and HDFC has raised up to 20 basis points. So when you look on the way down, when you had more than 100 basis points fall in home loan rates, and you're talking about 10 basis to 20 basis points hike, it's not all that substantial. I think if you looked at the Reserve Bank policy and what they indicated, if inflation numbers indeed come out as has been outlined, I think you're likely to see rates being stable. Yes, there may be 10 to 20 basis points more than what you have seen maybe last year, but there is bound to be stability in the rates, and if there is adequate supply, even if the demand increases, rates are likely to remain range bound unless something dramatically changes in the interest rate environment, which is not envisaged if you just saw the RBI credit policy. So my own view is rates are maybe 10 to maximum 20 basis points here and there, likely to be stability in the rates. I think the environment is conducive both from micro as well as growing micro and macro, as they say. So I think it will be more stable than any sharp increase in rates, at least for the next 6 months as we see it.
I have a very simple follow-up question. Up until now, we've not seen any large retail delinquencies. But if I look at some home loan buyers, they are feeling the heat of retail delinquencies. Banks have done a great job of maintaining delinquencies low. But do you think now it will be difficult to maintain this kind of a low retail delinquency? I'm not talking about Kotak, but I'm talking about across categories.
See, ultimately in any lending, retail or wholesale, it is the strength of your underwriting philosophy and the rigor of your underwriting that determines how delinquent or otherwise your portfolio is. There are segments, there are markets, there are customers, there are kind of collaterals. All of these various factors in the retail can contribute to delinquency. I think retail has had a great run so far. There are 2-3 things that have changed in the retail lending if I say post 2008. I think organized data, for example CIBIL scores, for example transactional data that you can get today has made lending much healthier than what it was maybe in 2008-9 when you saw a contagion in retail assets. So retail lending is a little more scientific now. Having said that, you can go wrong in your underwriting philosophy even with all the data available. My sense is, you could see a cycle, maybe not this year, maybe into the next 2 to 3 years, but I think ultimately it depends upon how bad or how wrong did you go in your underwriting philosophy and how aggressive did you go, just to be in the game. So I think it's about right underwriting and right pricing for the risk. These two, I think, will determine how delinquency will hurt, but you could see a cycle coming maybe in the next 2 to 3 years. You never know.
Okay, so I just want to take that point forward, and again, I'm not trying to be specific here. This is more like a a specific discussion towards retail sector per se. Where can you talk about decent visibility within the retail portfolio, and where do you think within the retail portfolio for the industry there could be a cyclical effect where delinquencies could move higher?
That's a very technical, looking into the crystal ball kind of question. It could be certain markets, it could be certain segments, it could be in affordable housing, it could be in personal loans, it can actually be in any segment. See, ultimately, what can cause stress in a retail book? When there are massive job losses. Okay, so when huge job losses happens, then people who've taken loans, whether it's a home loan, whether it's a credit card, whether it's a personal loan, whether it's any loan, that can happen. When an SME sector gets into trouble, the small really SME sectors, then the kind of working capital loan, the business loans, etc. can get into trouble. So I think the environment will be the first reason why you could see delinquency in either the individual side of the business or the non-individual side of the business. So the non-individual will be linked to the economy, the individual side will be really linked to the job losses and the job environment. If both continue to be stable, then you'll probably see some stability even in the retail lending space. If one of them go horribly wrong, then you are likely to see increase in delinquency. So I'd say root cause is economic as well as job creation. Then really comes the underwriting, and then you get into segments, market, etc. So I think a combination of these factors will really determine where you could see some delinquencies coming from the sector.
Finally then, we are on the brink of an earnings season which closes out FY18 and stares into FY19. The retail growth has looked very strong. Do you think FY19 would also spell, mid-teens to high-teen double-digit retail loan growth, or it could be even higher than that?
I think I would go more by the consumption demand and the consumption that we are seeing. And you have read every data, including the RBI credit policy, which says that there is strong demand pattern across cars, two-wheelers, tractors, construction equipment. You've seen aviation traffic. So when you look at consumption pattern across urban and rural, I think it indicates that the retail demand could continue to be stable and strong and on an uptick. If that happens, then opportunity to lend in the retail space will continue. Of course, you are, like India, you will have to depend on what happens to the monsoon, which could affect maybe the rural segments more than the urban segments, but it does has an overall impact on food grains, inflation, interest rates. Second, I think if rates continue to be stable, which is critical again from the retail lending business, then you could continue to see the uptick in demand and the growth that you're talking about. And rates are really dependent upon inflation. From whatever we hear in the policy, it seems like a stable outlook as far as rates is concerned. Third, economy. All points are indicating that economic growth this year is likely to be 7.4% on the GDP, which is higher than the 6.7. So if you put all these factors together, no reason to believe why growth in retail will continue this year as well. Any one of these variables changes, you'll have to wait and watch.
Shanti, always a pleasure to have you on ET Now. Thank you for your insightful thoughts, and thank you for accommodating this interview request.